Hi everyone. Good evening. Okay. So we will be having a discussion on the last problem on external financing needed that was given to you last week. So this is problem labeled problem 5, Darren Incorporated. So you have Darren Incorporated's balance sheet for last year is as follows. So you have cash, AR, and inventories, your current assets. Then you have your net fixed assets and your total assets. Various liabilities and equity is given as well, giving you a total liability and equity equal to your total assets initially. Last year's sales were 100,000 pesos. It is expected to grow 50% during this year. So 150K times 1 plus 50%, you would have next year's coming sales of 150,000 pesos. Last year, fixed assets were operating only at 85% capacity. Profit margin will remain constant this year at 5%, and 60% of the earnings are declared as dividends. So let's start with the first question. What's the level of sales if the company is operating at full capacity? So accordingly, last year, sales of 100K only consumed 85% of the capacity. So that sales last year 100,000. This coming year's sales would be 100,000 times 1 plus 50%, 150,000. Okay, so let's answer what would be the sales at full capacity first. So your sales at full capacity would be 100,000. Last year's sales divided by the capacity percentage utilized, which is 85%. The sales at full capacity is therefore 117,647. That is the answer for number one. That is the answer for number one. 117,647. That would be your sales at full capacity. Now, this would be a problem when we calculate the EFN. Remember, as emphasized a while ago, the sales at the coming year or during this coming year, we expect the sales to be 100K, add 50%, 150,000. While there is still excess capacity that can be utilized for your fixed asset purposes, no? This is not enough to meet next year's demand of 150,000. So again, sales last year are 100K. At full capacity, we can accommodate 117,647. But next year, we expect sales to be higher than that at 150,000. This is a situation where you have excess capacity, but the excess capacity is not enough, no? Not enough to cover the entire sales for the coming year. So from 100K to 117,647, take note that your fixed assets need not grow. No growth needed in fixed assets. We are still within the capacity of the fixed assets. From 117,647 up to 150,000, however, do we need to grow our fixed assets? Okay? So remember, at full capacity, we need to grow our fixed assets. If we still have excess capacity that's sufficient, no need to grow our fixed assets. This is a middle ground situation where your fixed assets are not yet at full capacity. That's 100K, there's still room to grow, but this would not be enough to cover next year's sales. So you would come up with an awkward situation where the growth rate of your current assets, which is in line with sales, is at 50%, is not the same as the growth rate for your fixed assets, no? Iba yung magiging growth rate ng ating current assets dun sa growth rate ng fixed assets. So let's calculate the growth rate for our fixed assets. So if next year's sales is at 150K, our fixed assets have a current capacity of 117647 in sales. 150K minus 117647 divided by 117647. Your fixed assets are expected to grow by 27.5%. Should we want to push through with 150,000 sales next year? So you will have separate calculations for growth of your current asset and your fixed assets. So separate will be the calculation of your growth of current assets and fixed assets. Let us now calculate the EFN. What is the external financing needed? That's number two. The EFN is your growth in spontaneous assets minus the growth in spontaneous liabilities minus the growth in retained earnings. Your growth in fixed assets and current assets would be calculated separately. So you would have two calculations for the growth of your spontaneous assets. Current assets, 10, 25, and 40. That's a total of 75K. That should grow in line with sales at 50%. Net fixed assets, also 75K. As calculated, the growth rate needs to be only 27.5%. There you go. Two calculations for the growth of your spontaneous fixed assets. Now, for your liabilities, however, the growth of your spontaneous liabilities, this is calculated as your spontaneous liabilities amount last year. That would be accounts payable 15K. Notes payable is not spontaneous as discussed last week. Accrued expenses are spontaneous. So 15K plus 15K. This debt is not spontaneous, no? Kasi debt ito. It won't automatically grow with your operations, no? With your sales. So you have 15K plus 15K. This is 30,000. This should grow by 50%. As for your retained earnings growth, okay, minus the growth in retained earnings, no? Okay, we have sales next year. 100K times 1.5, 150,000 times the profit margin of 5% times the plowback ratio. If your payout ratio is 60%, your plowback ratio must be 40%. Then there you go. EFN is 37.5 plus 26.25. That's the growth of your assets. Minus 15,000, that's the growth of your liabilities. Minus 3,000, that would be your addition to retained earnings. Your external financing needed must be 40,125. Your external financing needed, final answer for number two, should be 40,125. And that would conclude my discussion for this final problem, no, of Darren Incorporated. Thank you.